Welcome to this episode number 32 of Your Next Trade, called today Buy Wednesday Close. Before going into what happened this week, I would like to mention a video that I just released, which is called the 10 Trading Lies Keeping You Away from Making Money. That is something that I did over the week, explaining how you, most of the time as a retail trader, young retail trader, you'll be losing money. Why? Because educators and brokers would like for you to dream and be putting your money at work with huge leverage. So we already got some reaction from some brokers and educators that are obviously upset. And obviously, when you put a lie, you're going to be putting this lie as long as possible, as long as you're not going to be uncovered. So that is for this weekly session that we did on Thursday. So now look at the week and look at what has been happening. And I would like to mention the buy Wednesday close. So what has been happening since the lows of so this is on the beginning of March of this year, where you remember we got the regional bank crisis. And since the lows around the 10th of March, the market has been really strong and putting the same behavior, which has been pushing higher anything that is being tech, Nasdaq. And interestingly, if you look at the pattern over the days, there has been a strong performances of indexes of the FANG, of the Microsoft, the Apple, the Google, the Tesla on Thursdays and Friday. So here, this is for the S&P 500. You see on the Thursday, since the start of the year, market is up on Thursday 0.26% and 0.4% on Friday. So this is obviously much more than the bad performances that we will have on Tuesday and Wednesday. And more interestingly, you can see the strong performances that we had recently and the strong performances that really started from mid-March onwards. And the reason is pretty obvious, is market has been really pushed quite a lot by those weekly calls, by those options that will be expiring on Friday. So most of the Greeks and the volumes will be starting to push up from Thursday onward. So when I say buy Wednesday close, obviously it comes with a caveat, is everyone is now aware of this situation. And as a disclaimer, this is not because it happened in the past that it's going to happen in the future. So don't blame me. But I think this is a really interesting pattern that has been happening recently. And you could do the same. I put on the Discord channel for the free and the newcomers one Excel document, and you can be playing with it and see, how the stocks like Microsoft, like as I said, Nvidia, and all the big names, the tech names, the Nasdaq have been outperforming and really strong on the end of the week on Thursdays and Fridays. So let's look now at the year-to-date asset performances, looking at first at the S&P. So S&P now up double-digit, 11.5%, Nasdaq 26.5%. So we had a strong rally recently since the lows of March, and we had a bit of an acceleration over this week where we had some breakup, as we're going to see later. Stock 600, looking at Europe, actually a bit underperforming. So it outperformed at the start of the year, and over the last couple of months it has been not struggling, but in relative performance not as strong as the US stocks. Nikkei, Japan making new highs, so very, very strong. Emerging countries, emerging market, not that strong because they are still struggling from the higher cost of money, from higher commodities, so that is a bit of a struggle. Looking at the currencies, we are a bit flattish. Looking at the dollar versus most currencies, Bitcoin still the same story. But I think more importantly, this is the second part, which is the week-to-date asset performances. So we get the resolution of the debt ceiling last weekend. Monday was closed in the US and in the UK. So market didn't move that much at the start of the week. And literally, as I said before, the Thursday and the Friday kicked in. So we had the breakout on the S&P, up 2% roughly on the week. Russell, actually, which was a laggard so far, has been outperforming, and the outperforming was mostly as of yesterday, where many stocks, as we're going to see, the cyclicals, the materials, the industrials outperformed the overall market. And as you can see as well, Euro stocks, Europe flattish on the week. Emerging market doing a bit better. FX to the dollar pretty flattish. But we had some move, -1%, +1% over the week for the dollar. Crypto more or less the same. Interestingly, WTI is still weak. Copper, let's say a bit up, but we are flattish on the commodities. So there were some headlines yesterday that China will try to do another stimulus based on the construction and the real estate that has been struggling. So that has been helping the sector. There are some other talks that there might be or not might be over the weekend some OPEC cuts. We knew that there were OPEC cuts like it was a couple of months ago, 1.5 million barrels. The supply is not as strong as expected. The demand is not as strong as expected. So that means WTI is trading in the low 70s. So what about the year-to-date industry performance? The picture more or less the same. Big winners, sectors, the semiconductors and technology, other end of the spectrum. We get the banks, but I think to understand better of how has been this strong week is starting with the S&P, which is here, and you can see many industry sectors have been outperforming. So if you look at the previous videos that we've done, most of the time the market breadth will have been very poor. So you will have had only a few sectors leading the market, whereas really this week what has been interesting is the market breadth caught up, and we had many sectors, industries that were struggling that actually outperformed the overall market. And you can see the names. We go from the banking, obviously, which was a laggard, but it's not only this that is interesting. We got the real estate, and we're gonna jump rightly into the week to date sector performance. This one is very interesting. So here I'm looking at the S&P up 2%, which is good, but industrials, materials, consumer discretionary, so anything that is cyclical and telling you that the market is now, at least for the week, has been repricing a better growth going forward in H2. So the fear has been and is still to a certain extent that the US will go into recession. What the stock has been pricing this week and the bonds as well is actually the growth is still there in the US. It's probably not the best, the strongest growth ever. We are talking 1-2%, but at least we're going to have a growth for the next 3 to 6 months. So this is what is priced by the market. If you look at the rates, looking at the US 10 years, 3.7%, so a bit up from the 3.4, 3.5%. The yield curve, it's still telling you that recession is coming. I know that some people will say, okay, this is not working, but over time, you need to have probably a lag of 18 months to 24 months before the recession starts. So let's look at this one, which is interesting. So this is the Fed expectation. So last week I didn't do any YouTube video over the weekend because I was a bit busy. But so the Fed fund rates stand these days at 5.08%. So if you look at the expectations for this FOMC meeting coming at 5.13, that means roughly the expectations are for 70% no change to a 30% change. Keeping in mind that from today, the Fed is in blackout period, so there's not going to be any update from Fed speakers. But more interestingly, I would like to be looking at December. So December here, those two December. So the first one is the December expectation from the Fed that we had a month ago, where you remember we were expecting, market participants were expecting the Fed to cut rates by 40 bips, 50 bips, like let's say 2 times 25 bips cut between June and the end of December. What is interesting now is the market, if you compare this 508, this 506, so those two, there is absolutely no change. In other words, now the market is expecting no change between now and the end of the year. In other words, that means the market participants believe that there is less chance of a recession, and that actually we're still going to have some inflation. So peak rate now have been moving as well. So the peak rate, which is the 530 that we have here, are around August, September, which is a change again because, so far many market participants were expecting around June, me included. So that means we're going to have a pause probably in June, and market is pricing a 25 bips cut somewhere in between July and August. So kind of delaying of the potential recession that is not playing well for my book, but this is what the market is pricing. What about the VIX? Looking at volatility, VIX is not the perfect tool to do it, but it's an easiest one to understand where is the volatility. So now the VIX, the implied volatility for the next month is at 14.6%. You can see that the VIX term structure is still pretty strong. In other words, there is still a lot of hedging going on, but you can see as well that this is something that we mentioned before, that very often when the VIX goes below the 16%, 15%, that means the market is much more calmer and is expecting, an okay economy in the next few months. And volatility goes hand in hand with expectations by definition, and the expectations about the economy. And the expectations these days are for the economy for the next 3 to 6 months to do fine based on, what the rates have been telling us, what the stocks have been telling us, with the volatility has been telling us. So we will have to check, in terms of macro, what is the story. I still want to believe that, H2, you're going to have some problem for the US consumer. Why? Because, the reserves are almost over, and we are talking October, November. Plus, you do have some stories about the debt for the debt students that will be kicking in again, the repayment. So I'm talking my book. I've been wrong for the last 4 or 5% on the S&P. For Europe, actually, I'm more or less in the money, but that doesn't mean that I'm making any money these days. So as always, you need to be very factual. The market is telling you something, and there is and this is what is happening. So let's look at the story through the technical analysis. So what is the technical analysis telling us? We were looking at the 4200 level on the S&P for quite a long time. We broke this level over the last couple of days pretty strongly. Actually, if you look at the volume on the Nasdaq yesterday, it was really strong. And what are the next level? The next level, you're going to have the 4320. Not only because it was the highs of last year, so in August 2022, but more importantly, you do not know that JP Morgan is having this big collar, which is putting position every quarter, and one of the position is a 4320 call that is expiring at the end of the month. So you should be looking at the S&P, but roughly, that is a magnet that the market has been targeting. For the bull, obviously you get the breakout, and you do have very often when the gamma starts to kick in, and as we are going away only 2 weeks away from the option expiry, one of the biggest of the year, that could be another play for the bull. So in terms of positioning, what do I have? I have a bit of SPY short, and I do have some put spreads. Again, it's not really working. You have to be, I'm not going to bullshit you. As I said, I can't be saying, 10 trading lies. My book has been flattish for the last 3 to 4 months. And year to date, I'm flattish. What about the Nasdaq? Nasdaq has been very strong. The picture is the same, outperforming massively the overall market. And interestingly, if you look at the Russell, so Russell was really, really strong yesterday. So we had a big move. If you look at the Nasdaq versus the Russell, we knew that the Nasdaq was outperforming that much, but you see this kind of reversion to the mean. Is it a one-off? That means there was some follow-up, and the follow-up that you can see are on names like Caterpillar. So Caterpillar yesterday extremely strong, like up 8%. So I think it's based on obviously the economy, the expectations of the economy changing a bit to H2 no recession, and obviously as well the headlines from China saying, you know, we're going to be more active and we're going to be putting a stimulus at work. So that is helping anything that is cyclical. And here I want to go into the XLI, which is industrials versus the S&P. You can see the big move that we had over the last couple of days. You can argue, and you know, for a bear like me, recently that has been probably the only way to survive is we are only back to levels that we had last week. If you look at the XLB, materials versus the SPY, that's the same. So clearly the kind of rotation that we had yesterday, especially on the open, where the Nasdaq sold off a bit from the open, Apple, some of the big names sold off, and versus, you know, the strong Russell, sorry for that, so Russell pretty strong. So I think in terms of trends, you know, it's and I've been pretty poor, I have to say, over the last 3 months, is the trend has been pretty clear, and I'll be looking at the leaders, and one of the leaders is obviously Apple. And looking at Apple, as long as you get this trend, you can argue that the market is going to be strong. So this is your trend line. If it breaks this trend line, then there's going to be a change in the overall story. Emerging market, you know, not doing that much. So I mean, this market is not easy to read in that sense. Caterpillar, as I said, Euro stocks, stock 600. Looking at Europe, I'm still short. We had a couple of days that are pretty good, but overall, not much doing over the last months. This is the same with the DAX. Looking now at oil, I think oil is telling you same as copper, that the economies, the underlying, are not doing as well as stocks are doing. So euro dollar, kind of flattish recently, same with currency. So this is it for the technical analysis. Now we'd like to be jumping back into what happened for the week. So this is here we're gonna have the S&P futures over the last 5 sessions. So that was Monday. It was that is for the S&P futures again. So market was closed, nothing happening. A bit of a sell-off. That was Tuesday, Wednesday. And then what we have is Thursday and Friday. And guess what? From Thursday onwards, we kick in. The options are kicking in. So what we have here is the ISM manufacturing. So this is here ISM manufacturing, when the numbers came more or less, at least the headline, as expected. We have inflation that came down into the low 40s, so that's a positive, but inflation will have been, you know, same level as it was, let's say, 3 or 4 months ago, but the new orders keep on coming down. So this is, if you believe that the new orders are important, because this is the leading indicator of the leading indicator, you should be caring. And that means, again, so far what the market has been okay with is actually manufacturing struggling versus an okay services. So as long as this picture is the same, where services are not plummeting, that means we're still gonna have growth, and the market is okay with this number. And when I say the market, that will be stocks. So we had the S&P, as I said, 500 breaking the 4200, really big time. And you see the acceleration from the open. Friday as well, what we had was the NFPs for the unemployment in the US, where the headline number 300 plus thousand was a very good number. But if you look in depth of the numbers, I'm not saying that as someone being a bit bear, but it's more like there is a discrepancy between the headlines from the NFPs and some other reports. So, and there are many indicators that have been pretty hard to read over the last 3 to 6 months of this economic cycle. But overall, the picture is the same. China's new stimulus. So we had some headlines yesterday that, as I said, China will be doing and pumping up more money. So that has been helping the miners in Europe, the miners in the US, and a lot of the XLI, XLB, and Caterpillar, and you name them, that did pretty strong. So what about coming back into the ISM manufacturing through the JP Morgan Global Manufacturing PMI? Picture is the same. We are at 49.6%. So that's the same level that we had over the last 3 months. And the market kind of saying, okay, we are stabilizing at this level, that is fine. I still want to believe that the next leg will be down, but so far I've been wrong, roughly by 4 to 5% from the for the indexes. We had a bit of USD weakness at the end of the week. Debt ceiling sorted, and finally I would like to mention S&P 500, the stock S&P 500 last versus the earnings. So in white here, this is the one you get the S&P, which will be on the right hand side around 4,200, and in blue you get the earnings of the S&P, which is for the expectation for this year. So roughly these days we are standing at $218, and what the market has been enjoying or liked over the last 3 months, and actually that the earnings expectations are not going to be coming down. So if you think about the 218, times 20 or times 19, that puts you in between 4,200 and 4,400. This is what the market is pricing, but the market has been digesting the fact that economy and earnings has been stabilizing, and we're not going to go lower, and market is probably still now looking forward into 2024 now, looking at potentially 240, 250 for the S&P. I think these expectations are way too high. I think the market is never mispricing, but that the expectations are too high and not taking into account what is going to be happening in H2. But more or less what you see is the S&P earnings has been stabilizing more recently. So what about the catalyst going forward? First thing first is the Fed is in blackout period from today. So that means no headlines before Wednesday in 10 days. So you should not expecting Fed speakers. You're going to have some people leaking some data and some views that would be from the Wall Street Journal, for instance. But as I said, expectations are mostly to 70% roughly for no hike, like a neutral and no change. And then maybe again another 25 bips in June and August. So we are getting close to the end of this hiking cycle, but just before the Fed meeting on the Tuesday, we're going to have the CPI, so that's going to be interesting. So what about the drivers? As you can see, they are less than usual. We're going to have on Monday the PMI services, so that will be for the US and the rest of the world. We know that so far there has been a strong divergence between services and manufacturing, where services have been doing pretty well. We need to see if we carry on. Other macro numbers, we get the Euro retail sales, durable good orders on Monday for the people that are trading FX. We're going to have the Bank of Canada red decision where the expectations are for no change. And as usual, we're going to have the initial jobless claims. What about the earnings? We don't have that many earnings, some of the few names, but I think more importantly, and that's something that I flagged on the Discord community, the market is between earnings season, okay? And what happens is most companies will go to conferences and they will be updating the market. And obviously one of the big noise of headlines have been through the AI, artificial intelligence. So you should be checking any companies that has exposure or those seen as being exposure and what they are saying in the market. So I think it was on Thursday, on Wednesday, Intel came at a conference. The stock really went higher by 6-7% on the day. That is something that I flagged, not necessarily that they're going to be saying what they will be saying, but more about the timing. So what we're going to have this week is on Tuesday, there's a conference where you're going to have NVIDIA, AMD, and on Wednesday, ASML, some others. But do that not only for AI, but do that for most companies, because what market participants have been pricing, at least for this week, is a better H2, meaning that cyclicals, industrials will be better than what was feared, let's say a month or a couple of months ago. So that is what the market is pricing. Let's see what companies will be saying. If you look at the US retailers, there is a huge divergence between, somewhat of the big discounters have been saying that they are really struggling, and some of the names like Lululemon with big exposure or not only regional exposure have been saying. Finally, two things. So the bit of seasonality, because I didn't do the video last week. Normally the S&P is a bit struggling in June. So far that is not the case. We're up 2%. So that is something that is not really playing out. And I'm looking at the market breadth. The market breadth being, here I'm looking at the chart, which is the advanced decline. And you can see that the advanced decline is still the same, which is, the underlying how the market is going higher is not as healthy as you could think. So this is overall for the market. Implied volatility. Now the looking at the SPY weekly straddle 1.2%. What is interesting is last time the Fed was in blackout period, and we were the week before. And the option expiry, I think the market really struggled despite having no catalyst and no one talking. So this is what I'm looking for this week. Looking for, don't have that many catalysts, and overall, as I said, market has been very strong. I'm pretty fine in saying that I've been wrong over the last 4 or 5% for the S&P. In terms of macro, again, market is pricing a better picture for H2 than it was a month ago, and you can see through the rates, you can see that with the stronger dollar, and you can see that as well with the stocks, and how the more recently the price action of industrial cyclicals have been doing, at least for the week. So this is it for me for the week. Again, after this video, I will link this video to the 10 trading lies keeping you away from making money. I think this is an important one. Most educators, brokers will push you hard and really create an action reaction for you to be trading, and they are really playing with your weaknesses. And I think, unfortunately, I'm seeing the damage at the end of the curve. So this is it for me. If you get questions, if you want to join the Discord community, that'll be great, and I'll see you soon. Bye bye.